Earlier this week, I was looking at the market screen and humming to myself. The song was Here Comes the Sun. You've probably heard it. It's a song by the Beatles that was written by George Harrison. And if you think about it, the song perfectly captures the mood for the Indian investor. The lack of a trade deal and uncertainty that brought was the dark clouds that refused to go away. That is, until earlier this week, when the sun finally came out. This is Moneywise on NDTV Profit, and the question that I'm asking today is whether, after what has been a tough year, a long, cold, lonely winter, as George Harrison wrote, whether your equity portfolios will start looking healthier, whether the sun will come out. My guest today is Ramesh Mantri, Chief Investment Officer at WhiteOak Capital. Ramesh, thanks so much for taking the time.
Thank you, Alex.
And there are so many songs that capture hope like that. But to start with, whether you like him, whether you don't, Donald Trump has dominated headlines and, in fact, the course of our portfolios over the course of the last 1 year, hasn't he?
True. So it's like, I'll continue with the song. This one, a Hindi one. Dushman na kare, dost ne hame dar diya hai. Right. So it's been, US is our biggest partner, our, two biggest democracies. So logically thought that we wouldn't go through so much pain. But finally, I think we have come together.
And it's important that you say that. A lot of people will remember this when initially this whole conversation about tariffs and trade negotiation with various countries was happening, and this is before August of last year. The consensus view was that, of course, India is going to be right up there. India is never going to have the tariff problems that other people do. China got the tariff problems first. No, there's going to be a great deal that is going to be signed. And then you have 50% tariffs that came on India, more than any other country in the world. And we dealt with that for several months. Were you anticipating that?
No, let's clear. With this current US administration, you cannot anticipate anything.
So how do you, as a money manager, then deal with things? And of course, you would be bottom up. You would look at these things, but you would have to keep like a sea captain or weather eye on the horizon, right?
No, that's a great question, and that's why you realize that in the short term, there's just too much noise, right? There's just too much noise, and particularly with the US administration, there's noise every day. So actually, you have to let the long-term logic of economics, you have to anchor to that, that what is rational long-term? What is the natural relationship? For example, US and India are natural allies, right? India, of course, US is the largest customer with IT services, exports, and pharma, and growing exports in other sectors. And think of, for American companies, like who dominates the whole internet space in India? It's Alphabet, it's Apple, it's Amazon.
Yeah.
So for them, we provide a very large market.
Meta as well.
Yeah, Meta, of course. Meta is like, India works on Meta, right? Yeah. We communicate on Meta. Yeah. So it's a relationship that works together. So it's a very natural relationship that we come together. And then, of course, democracies and also natural geopolitical partners.
So you're saying that sense had to prevail eventually.
Yes.
You were waiting for that to take place.
Yes, it just took a little longer. The journey was a little more arduous. Right?
So, and that's had a bearing. Let's face it, as much as statements were made in the run-up to the deal being signed to say that, it's an impact of 30 basis points on GDP, and you would have to reduce your expectations on the macro side to that extent. There was a sentimental impact. Foreign institutions were refusing to come in. The rupee slid to where it was, and then it climbed back very sharply. There was an impact.
No, that's one, of course, is everything happens at the margin. For businesses which were reeling under the 50% tariff, whether it were garment, chemicals, auto components, or capital goods, it was extremely painful for people who were running those businesses. So we can't think of 30 bips at a high level, but not looking at the specific pain that individual companies go through. Yeah. And there was also a significant and growing uncertainty on how long this pain lasts. Yeah. So that's the real issue, right? And so now it's a great relief.
It's a great relief. Okay, I want to talk now. The way that I would like to do this conversation, and to everybody tuning in, is that I would like to start wide, and then we'll go deeper into your portfolio in India and how you've constructed it, what your thesis is as well. Now, as we talk about this, Ramesh, the other factor is this AI trade that has been dominating through all of last year. to the exclusion of practically everything else, there is this commodity underlying uncertainty and volatility that is taking place, and you can maybe carve out a story of precious metals within that. And then you have India, that is an anti-AI trade, so to speak. So how do you put all of this into context the way that you think about it?
First let's understand, AI is a clearly game-changing technology. The rapid pace at which it's finding adoption, right? And every week something new breaks out. Constantly every week there's new evolution of models, just this week we had, in the last couple of weeks we had where coding is less required, right?
Yeah.
Right. It's rapid pace of evolution, and I think it will have large scale, I would scale up of use cases. Right. So I think to me it's a defining technology. It's clearly change, and actually the pace at which it's changing is frightening sometimes, right? So I believe in the long-term opportunity, but of course markets can overdo investment thesis.
Has that happened?
I think there's a difference between creating long-term value for society and for businesses and what stock market prices have assumptions of. That sometimes there can be large disconnect. For example, the internet has been a defining technology, but there was a tech bubble, the internet bubble. So a lot of things can be defining changes, but there can be bubbles in the middle, overvaluation, phases of overvaluation. So that is one. But of course, India, I would say, is not a beneficiary of the trade. In fact, there are a lot of worries that the Indian IT industry gets negatively impacted if it is, if AI can be very disruptive there. The other story, of course, is precious metal. Partly, there's this narrative about de-dollarization, lack of trust. Maybe partly true, but then from being a safe haven, it became a speculative commodity, right? And I can understand the role of gold, because gold has always been a reserve asset, for the civilizations. But silver actually is a more usable asset. It's not
60% is the rough estimate of industrial use, right?
So the way the prices had moved, clearly industrial applications had started becoming extremely challenging. We've spoken to solar panel manufacturers. In 3 months, they reduced production by consumption of silver by 50%.
What were they doing instead?
They're using alternates, copper, aluminum.
Sure.
Yeah. So because that's how capitalism works. When prices move, people find substitutes.
Alternatives.
First, demand falls, and then product gets substituted.
In fact, we were speaking to a commodity or somebody who tracks the commodity space very closely, and what he was saying is that first thing is demand destruction.
Yes.
And that indeed has taken place. You're actually saying that you spoke to companies, you saw that happen.
Yes. And eventually, if prices remain high enough, then supply starts turning up.
Okay.
Yeah, at very high prices, even very poor quality mines become financially viable.
Interesting.
Yeah.
Okay, so and that may be true for any commodity. I think you can look at even crude at some point and talk about.
There's a famous line in commodities called "the cure of high prices is high prices."
Wow. Okay, that's very interesting.
So if you have high prices enough for a long enough period, there's a demand destruction and supply turns up.
So, but having said that, this entire narrative on gold, it may well be true, considering that a lot of central banks around the world are also have been buying for 4 or 5 years now. That only gathered pace when this whole Russia situation took place, right? With the amount of wealth that they had that got sequestered, it wasn't returned to them. That is in Europe. But you have something to say about that?
No, I would say, forever for civilization, gold has been the reserve currency or the currency of trade for the world. The concept of fiat currency as a global trade currency is a relatively recent phenomenon. Right. It also shows a less lack of trust because a fiat currency actually fundamentally requires trust.
Yes.
So the geopolitics, the breakdown of relationships between countries, the past relationships, all are fractures to the belief systems.
So therefore, from that perspective, it is a good thesis to have gold in your portfolio for long term, right?
See, actually, if you look at a very long term, gold does exceedingly well in two kinds of environments: in periods of significant uncertainty and high inflation. We cannot say in India particularly we have an inflation problem. We don't have an inflation problem. But has the uncertainty gone up a lot globally? The answer is yes. So gold is actually an insurance policy.
Okay, gold. Gold, and we'll come back to that because you've got a multi-asset fund where you utilize this policy very well, and you have. I'd be very curious to find out what your strategy is with gold and commodities as things stand right now. So, but let's now narrow the focus to India, because the reason I want to ask you about this AI trade and then ask you about India is because the arguments that are made in favor of India, fastest growing economy in the world, relative strength with regard to demographic dividend, a per capita that is growing, a consumption pattern that is shifting, a lot of opportunities here. So why then does this economy, does this market look so unattractive from the outside in, just purely basis the flows that we've seen?
First, there's this new AI was a disruptive technology, and India didn't have an AI story. So the money, of course, flew to, moved towards countries, US and, let's say Far East, China, Taiwan, Korea, which have AI technologies.
And those markets were also depressed.
Yes, and they had done very poorly, particularly China. The year 2024 was struggling. So the markets had done very poorly before that, and then this AI story emerged.
Sure.
So India did not have that narrative. That was the clear thing, right? And of course now that story, of course, has played out quite a bit. Maybe, who knows, it has got overextended. But I think the India story is clearly improving. First, we have had monetary easing. We have now lot more supportive government policy, and particularly with the trade deal done. I think a lot of fundamentals are aligning.
Describe them.
See, I think when you think of what are the fundamentals for a country? First is growth. Is growth picking up? Yes, because of the fact that the monetary policy has become supportive, and also government had cut income tax rates and GST rate cuts. Number two, the trade deals, which are again growth supportive, whether it's the EU FTA or the US trade deal, which were not there. Remember, they are forward-looking. They don't show in the current GDP, but they will show in the future GDP. So, and then what are other concerns? The other concerns, of course, is inflation or fiscal deficit are actually looking strong. The way the government has managed the fiscal deficit and inflation is low. So a lot of the indicators are positively aligned for India.
Okay, and this consumption thing, do you think that it's a lot has to still play out? Because we've been talking about the income tax cuts. This was in February of last year, and we were anticipating that, okay, the numbers will pick up, there will be huge consumption. Then GST happened. We're still waiting for a dramatic pickup in consumption. Ramesh, you have your ear to the ground, and you probably invest in these companies as well. What are you seeing?
So I think the money actually went into precious metal. Just look at the sales of jewelry companies in India, right? The way people have bought gold and silver in the last 6 months. I think all that my thesis is the large part of savings actually gone there. The fastest growing businesses in India are related to precious metal.
Okay. So there's been, to a certain extent, notional loss of value also has taken place with this latest fluctuation, right? But people have made a large amount of wealth. The tendency is, though, not to sell that jewelry, right? You buy jewelry and you keep it forever.
See, India as a country is the largest owner of gold in the world.
Right.
Even at current prices, the estimated stock of gold in India is higher than our GDP. So we are the richest country if you use gold as an underlying asset. However, India, it's never supposed to be sold.
Yes.
It's actually, again, an insurance policy. When a family goes through a financial distress, that's when they sell their gold. Remember, in India, the belief system is if you have to sell your gold, you are in a mess.
You're at rock bottom.
That's what happened to us when we implemented our economic reforms.
Yeah.
Remember, India had to pledge gold.
That's true.
India had to pledge our gold.
In the 90s.
Yes, and that's when we implemented the reforms. We changed our ways. Yeah. Because we hit a rock bottom. Yeah, so India, if you pledge your gold, you really hit the rock bottom.
So that is the reason. The diversion of funds that had to go towards consumption has actually gone into creation of long-term wealth, which is unlikely to be utilized for any productive purpose.
Yeah.
Let's face it. I mean, you look great wearing the gold, but you're not going to use it for any productive purpose.
Yes.
So what does that leave us at right now? Does that consumption pick up now?
And the good part is with this recent price moves on precious metals, I think that euphoria hopefully has gone away, right? It's going to be more sensible, use-driven market rather than a more speculative market. So I think we can go back to basics now. And with the two, US FTA, US trade deal and the EU FTA, clearly growth prospects are improving. When I look at all our fundamentals, when we look at our asset allocation models, in the last 3 years, we are closest to our all-time high equity allocation.
I'm glad you brought that up because I want to delve first before we get into your portfolio allocation as things stand right now, so that my viewers understand things. Everybody has a different philosophy when it comes to fund management and when it comes to asset allocation or portfolio construction. What is yours? And I ask this so that you can explain the context that you find yourself in right now, and all of us, by explaining that thesis.
Yeah. So first of all, we run asset allocation products, which is one of the simplest product, of course, is you asset allocate between equity and debt, which is a balance advantage fund.
Yeah.
There, when we run the model, when you put in the fundamental metrics there, clearly this is in the last 3 years one of the highest levels of allocations ever.
Sure.
So that's a clear sign that equities, at least that's our opinion from our numbers, is equities is looking attractive on a forward 3-year basis, right? See, the problem with investing is people look at the past and invest.
But I do want to ask, is this because you have yields that have already declined and monetary policy that has already cut rates and there's likelihood of not too much from this point? Is it because of that, or is this because earnings is looking up, corporate side is looking up, and so therefore equity basis valuations is looking attractive? Which is it?
So it's basically 18 months of earnings have compounded, but valuations have not changed.
Yes, okay.
That's a simple input.
So, but that's your balanced advantage strategy, and that's your hybrid strategy that lends itself to various other parts of its portfolio. What's your equity thesis when it comes to portfolio construction?
So on equity, our approach is very simple, and a lot of people who have now observed what has happened in the world in the last 5 years don't focus on the macro. Don't focus on high-level things like what the Federal Reserve is going to do, what the US administration is going to do, what's going to happen to oil prices.
You said it, there's too much noise.
Just too much noise. Just stay focused on fundamentals. Ultimately, when we invest in equities, we invest in businesses and entrepreneurs and at the right price. Those are the 3 inputs that go into the model, right? So we kind of reduce, not focus on macro when we take investment decisions. We think macro is given. We think of macro like a cricket toss. Does it matter? The answer is yes. But as a cricket captain, can you do something about the toss?
No.
Can you practice a toss 100 times before you go in the match and say, okay, I'm going to improve the odds of winning toss, and then I'll decide to bat or ball?
The probability will always be the same.
Yes. So I'm not saying it does not matter, but as a fund manager, can you do something about? That's our approach.
Yeah.
So we are entirely focused on our game, improving our own game, which is spending time understanding companies, entrepreneurs, and investing with them. Some of them will get impacted positively. Some of them will get impacted negatively by the macro. But if you diversify your portfolio across many such opportunities, the macro will not be important in your portfolio.
So then let's delve further into that. And when you look at the construct right now, and let's perhaps talk about your diversified funds, because that really will, maybe your flexi cap fund, because that'll give you a sense, or give my viewers a sense of how you've constructed your portfolio. And then maybe we can also talk about the broader funds, because then you will say that in that category, and we'll eventually get to that in the small cap space, where a lot of fund managers are now saying, look, there was froth that has kind of settled down and there are opportunities now. But first, diversified, how are you constructing right now?
So the way we approach portfolio construction is, first, you can think about, let's say, flexi cap fund. You can think about market caps. You can think about sectors. But invariably, the call you take if you decide, okay, I'm going to be large caps or small caps, is invariably ends up being in a macro outcome. Or if you decide sectors, that I'm going to be overweight, let's say, IT, that means you're bullish on US economy, or you want to be entirely bullish domestic consumption, which means you're bullish on the local economy and actually bearish on the global economy. These macro calls don't work over long periods. They work they can work for a short period. So the way we approach portfolio construction is, I would like a reasonably balanced exposure across all major sectors. Similarly, across market caps, we may like to be overweight certain parts of the market, but keep a reasonable balance across. And I'll give you a simple example. In our flexi cap, we are typically overweight small caps and mid caps. Not because we think small caps or mid caps from today will significantly outperform large cap. We just believe as an active manager, we have much higher skill here. It's like if you're playing on a home ground, that pitch may be difficult for every visitor, but it's because it's your home ground, you'll always play better on that pitch. So we think as an active manager, we can create a lot more alpha in small and mid.
So what is the weight of small and mid in your flexi cap right now?
It'll be about 35%.
Okay. And what is the size of your portfolio construct right now for your flexi cap fund in terms of number of stocks?
In terms of number of stocks, it'll be more than 100.
More than 100. Okay. So there's a significant tail. Would you agree? Why is that?
That's not to diversify. Actually, we believe you should go to the last stock possible, even 1,000 crore company. If you can even deploy 25 bips of your portfolio, and if you believe over a long period, that 1,000 crore company will significantly outperform, let's say, a very large cap company, you should put that money.
Okay.
So that 1,000 crore exposure of, let's say, 25 crores is constrained not because I don't want to put more money in that stock, because in a 1,000 crore company, you can only own so much.
Sure.
So some of the smaller tails exist not because we don't want to put more money there, because that stock can only absorb so much. So if you believe long term that tail will create significant alpha over, let's say, the easier decision to invest in large cap, that's why we tend to allocate money there.
Okay. So let me ask you this. At the peak of the small cap cycle post COVID-19, you actually had fund managers come out and say, look, we can't do this anymore. I need to stop lump sum investments. And I know for a fact that your house decided to not launch a small cap fund because you said, look, I don't want to get into that right now. The valuations are challenging. I might find it difficult to deploy. Is that a challenge you're facing right now?
No, I can clearly say things have improved quite a bit. Valuations have corrected. Bottom-up number of opportunities have expanded quite a bit. Valuations have corrected. The growth is still good in many segments of the small cap. So I would say if you asked me the question 2 years ago when we took that call not to launch a small cap fund, I think the environment for small caps is much better today.
And so now is the time for small caps? Would you say that? Would you go as far as to say that? So the reason I ask, Ramesh, is, and I'm not asking you to go out and exhort people to invest. That's not the intention. But the tendency of investors is when they have had a tough period, when their portfolios have underperformed or a particular scheme has underperformed, the tendency is to either stop or to redeem. The reason I'm asking you this is that when the chips are down, usually that is the moment to double down and say, I'm going to redeploy. I'm going to take more allocation right now. Is this that moment?
So we can always focus on what small caps have done in the last 18 months or look at what they did in the previous 4 years before that.
Yeah.
So they had significantly outperformed. So you can say this is a more a normalization rather than
return to mean.
Yeah, rather than this period of underperformance. So I don't think there's a reason today to believe that small caps will outperform, let's say, mid cap or large caps.
There is no reason to believe that it will not or will?
Not. As of now, we don't feel a strong reason that small caps will outperform.
Why is that?
Yeah, because one, valuations are still, if I compare small and mid valuations versus large cap, the premium is still high versus long-term average. That's the first point. Number two, remember, we are still in a volatile macro, the uncertain world. Normally, small caps are suited to when the sea is calm.
Yeah.
Right? When there's monsoon in Bombay, you don't take speedboats.
Yeah. That's a good point. Okay. All right. So therefore, your focus when you're looking at further deployment right now, you're not venturing too far into the broader markets. Is that fair? You're actually looking at opportunities in the mid cap and the
no. We are bottom up looking opportunities across the board.
Okay.
Because there are a lot of opportunities within the small cap, but we're talking at aggregates, the whole basket.
Understood. But the outperformance could well take some time to take place, is what you're saying. I do want to spend just a little time to talk about your strategy on gold, because you have allowed in one situation, and I looked at last year, if I remember in the first half, you allowed your gold allocation in your multi-asset fund to go double digit, right? It went to what, 17, 18, close to 20%. What is it at right now, and what's the thesis on gold for you?
So actually in 24, we peaked at 24%.
Sure.
So when equities was doing well in 24, our models indicated a very large weight on gold. It looked like counter call.
Yeah.
It looked for a few months that way. And then, of course, gold did exceedingly well. Now, when we look at our indicators, we brought it down to 10, right? And January particularly was an insane month.
Yeah.
And I'll tell you how insane it was. Normally, gold arbitrage returns are below risk-free returns.
Right.
Because globally, there's a leasing market for gold.
Okay.
So typically, the long term, if you look at a very long term, if you look at even the 10-year bond or short, even the T-bills, your arbitrage returns on gold are lower than that. In January, at points of time, they were more than 40% per annum.
No way.
Yes. It was an insanely broken market. So instead of deploying a lot of money on gold, we actually deployed a lot of money on gold arbitrage.
Wow. And so therefore that's the room for safety is more. With
Honestly, if you give me 20% return on gold arbitrage, I don't want to put money anywhere in the world.
Yeah, I don't blame you. And you're getting 40% on that. So therefore, as things stand right now, you've curtailed. I would think that would have normalized to a certain extent.
Yes. And in the last week, the insanity that played out in some of the precious metal market, things have actually normalized quite a bit.
Sure.
So we actually then added pure gold exposure when gold corrected.
Okay. So and this is something. It's not for the faint-hearted. It's not for the faint-hearted. Utilize opportunities and leave it to the experts. That I think is the message. The average Indian investor is not going to be having access to gold arbitrage, which is why you look at multi-asset as a strategy, and don't look to time the market. But Ramesh, it's been an absolute pleasure speaking with you. Thanks so much as always for taking the time. And is the sun out?
Yes.
The sun is out.
Yes.
That's a message that you can take heading into the weekend. Thanks so much for watching. This is NDTV Profit.